In 2001, Argentina defaulted on $132 billion of debt. It was the largest sovereign default in history at the time. And the IMF, the International Monetary Fund, the institution supposedly built to prevent this exact kind of collapse, had been inside Argentina for years, advising, lending, restructuring. They were there before the crisis, during it, and they watched it happen anyway. So either the IMF failed, or it worked exactly as intended. That question is going to follow us for the next 10 minutes. Most people, when they hear IMF loan, picture something simple. A poor country runs out of money. The IMF shows up with a check. The country stabilizes. Crisis averted. That's the story the IMF tells about itself. And it's not entirely wrong. But it's definitely not the full picture. Because here's what actually happens in almost every major IMF intervention. The country gets the loan, agrees to the conditions, implements the reforms, and then somewhere between 5 and 15 years later, ends up right back where it started. Or worse. Not once, not twice, over and over again. Across decades, across continents, Sri Lanka, Pakistan, Greece, Zambia, Ecuador, Argentina multiple times. At some point, a pattern this consistent stops being a coincidence and starts being a feature. So what is really going on? To understand it, you have to go back to the beginning. Not the beginning of a specific crisis, the beginning of the IMF itself. It's 1944. World War II isn't over yet, but the Allied powers are already planning for what comes next. They gather in a small resort town in New Hampshire called Bretton Woods. 44 nations with one goal: build a new global financial system so stable that another Great Depression becomes impossible. Out of that meeting came to institutions, the World Bank, to fund reconstruction and development, and the IMF, to stabilize currencies and prevent countries from running out of foreign money. The logic was elegant. If a country was hemorrhaging cash, it could borrow from the IMF, stabilize its currency, and buy time to fix the underlying problem. Clean, simple, sensible. And for a while it worked. Then the 1970s arrived. The US abandoned the gold standard, exchange rates went floating, and the world economy cracked open. The IMF, designed for one world, suddenly found itself in a very different one. It needed a new purpose. It found one. And that's where things get complicated. By the 1980s, the IMF had quietly shifted its identity. It was no longer just a currency stabilizer. It had become a gatekeeper. Here's how it worked. A developing country hits a financial crisis. Can't pay its foreign debts. Investors flee. The currency collapses. Government is out of options. The IMF enters the room. And here's the critical thing to understand. The IMF loan itself is rarely the most important part of the deal. What matters is the signal it sends. Private creditors, banks, bondholders, they woe and lend to a country in crisis without some assurance that it's going to clean up its act and pay its debts. The IMF provides that assurance. Its stamp of approval, what economists call a seal of good housekeeping, unlocks all the other financing. So the country in crisis doesn't just need the IMF's money. It needs the IMF's credibility. And to get it, the country has to agree to a set of conditions. Those conditions have a name: structural adjustment programs. And this is where the story gets dark. These programs became the IMF's primary tool. The logic was rooted in a particular school of economic thought dominant at the time: smaller government, open markets, deregulation, privatization, and fiscal austerity. It was called the Washington Consensus. The prescription was almost always the same, regardless of the country or the crisis. Cut government spending, raise interest rates, open the capital account, remove trade barriers, privatize state-owned companies. Do all of this quickly and you'll stabilize and grow. That was the theory. Here's what happened in practice. When a government cuts spending during a crisis, the first people to feel it are those who need public services most. Healthcare, education, food subsidies slashed rapidly to meet IMF deadlines. When a central bank jacks up interest rates, small businesses can't get credit and the real economy contracts. When you open your capital account in the middle of a crisis, you're just inviting money to leave faster. When you privatize state companies on a desperate timeline, you sell them cheap to foreign corporations or local elites. The government gets a quick cash injection, but permanently loses control of its water system or power grid. None of this is a conspiracy. It's just incentives and consequences. But here's the part people miss. Even if you believe in these policies in principle, the timing and speed the IMF demanded was demonstrably wrong. You don't implement austerity in a recession. You don't open your capital account before stabilizing your financial sector. You don't do all of it at once in 36 months. Even Joseph Stiglitz, the World Bank's own chief economist, said the IMF didn't seem to care if its programs worked. What it cared about was whether debtor countries kept paying their creditors. That points to the uncomfortable mechanism at the center of this system. IMF is a membership organization of 190 countries, but voting power is weighted by financial contribution. The United States has more votes than anyone, enough to block any major decision. The other major shareholders, Germany, Japan, the UK, France are all major creditor nations. So when a developing country can't pay its debts, whose interests do you think the conditions serve? The conditions almost always prioritize debt repayment to foreign banks often headquartered in the very countries that controlled the IMF's board. To be fair, the IMF has changed. After the Asian financial crisis, after Argentina in 2001, after years of documented failure, it adapted. Somewhat. The post-2008 IMF has acknowledged that austerity can be counterproductive. It's published critical papers on its own policies. But has the learning been structural or just cosmetic? The governance hasn't changed. The voting weights haven't shifted. And when you look at recent programs in Pakistan, Sri Lanka, and Argentina again, the basic architecture is remarkably familiar. Different language, same skeleton. Let's look at Sri Lanka in 2022. The country runs out of foreign currency. No fuel. No medicine. The president literally flees the country. The IMF arrives with a $2.9 billion package. The conditions? Raise taxes, cut subsidies, tighten monetary policy. Some of this was necessary, but here's the math that matters. Sri Lanka's total debt was about $50 billion. The IMF's $2.9 billion isn't a rescue. It's that seal of good housekeeping, designed to get other creditors to play ball. The actual adjustment falls on Sri Lankan citizens. Electricity prices surge, taxes go up, and the economy, already in free fall, contracts further. The creditors, they negotiate some haircuts on their bonds, but the process protects them. It is orderly. It is structured. That's not an accident. That's the design. Here's the deeper irony. These programs often make the debt burden worse. When you implement austerity, GDP falls. But your debt is in dollars. As your currency weakens, your debt-to-GDP ratio goes up. The cure includes a period where the disease gets worse, and that period is measured in years. And who lives through those years? Not the bondholders in Frankfurt or New York, the people in Colombo, Karachi, and Buenos Aires. Remember Argentina in 2001? After years of failed IMF austerity, the government froze bank accounts. Riots erupted, the government collapsed. Then, Argentina defaulted and stopped listening to the IMF. It restructured its debt on its own terms. Within 3 years, its economy was growing again, one of the fastest recoveries on record. The patient recovered after it stopped taking the medicine. Now, this isn't black and white. Domestic corruption and mismanagement are real. And some countries, like South Korea, did emerge stronger from IMF programs. But institutions have incentives that exist independently of the intentions of the people inside them. The IMF's structural incentive is to maintain the stability of the international financial system, which is a polite way of saying, make sure creditors get paid. When that goal conflicts with genuine development, the evidence suggests which one wins. What if the goal was never to fix the problem, not because of some evil cabal, but because of the system's structure? The global financial system runs on debt. That debt requires discipline. The IMF provides that discipline. In that role, keeping countries in a managed state of debt dependence isn't a failure. It's a function. A country that is perpetually restructuring and returning for the next program is a permanent fixture of the system, always manageable. So why does the IMF give loans that seem designed to fail? Maybe they aren't designed to fail. Maybe they're designed to do something else, to stabilize the system, protect the creditors, and keep the country manageable, and whether the country actually develops is a secondary concern. Maybe the failure is in what we expect the IMF to be, rather than what it actually is. It was built to serve the international financial system. And by that measure, it has largely succeeded. The question is whether that system is compatible with the genuine development of the countries that need it most. That question doesn't have a clean answer. Anyone who tells you it does isn't paying close enough attention. Thanks for watching. If this made you think, consider subscribing for more deep dives into the systems that shape our world.